Hey guys, it's Michael here with a video about what I consider to be the top tech-focused ETFs on the ASX today. I'll break down each ETF, going through what they're currently holding, what their management fees are like, whether or not they pay a dividend or not, what they're actually sort of tracking, as well as their historical returns. For those of you watching who don't know what an ETF is, it actually just stands for Exchange Traded Fund. And in short, it's just a simple way for investors to easily buy a collection of stocks through the purchase of just a single stock. It's a great way for investors to easily diversify without having to spend a lot of money on brokerage and gain exposure to sectors or wide sort of areas in the market without having to, of course, buy that many companies. Now, thankfully for investors who are actually interested in investing specifically in technology around the world, there's quite a number of great ETF choices now available on the ASX today that really weren't available even last year. And that's what I'll be going through today. But before I start going into the individual ETFs, I'd just like to share some of the pros and cons that I found when investing in these technology companies throughout the world. The first pro, and probably the main reason you're interested in watching this video, is the great returns. So if you look at sort of the last 10 years compared to versus just the total market, the return of some of these technology ETFs has been much better. Whilst this isn't really a guarantee of future performance, it is still something to consider. Tech stocks can pay dividends, at least some of them anyway. There can be benefits to buying dividend stocks to sort of deliver consistent earnings throughout your investing period, and it does sort of indicate that the company is strongly positioned to generate profits over time. You can actually buy shares in things that you use. Chances are you probably use some tech in your daily routine, whether that's a smartphone, a laptop, you might check social media, and investing in these large technology ETFs allows you to buy pieces of companies that you sort of know and you like. You can actually diversify within tech itself. Technology companies aren't a single industry monolith, and investing in these technology ETFs allows you to pick specific sectors you might be interested in and gain exposure to them. For example, you might be interested in robotics or cybersecurity, and there's ETFs that allow you to buy companies in that specific area. In terms of cons, the main one is obviously just the lack of diversification when you're looking at an industry-specific ETF. However, if you're looking into this video, you're probably not too concerned about that regard. Potential tech backlash. Some people think increased government regulation and security into privacy and the technology industry means that there's a potential backlash for these technology companies coming in the near future. However, I think we'll see that, like most things, a lot of these technology companies will be able to react in different ways and get affected in many different ways. So being able to diversify across a lot of them is actually really beneficial. Buying what you know can actually be complicated. One of the hallmark quotes from Warren Buffett is investing in things that you know. And whilst you might know how Facebook works or Google works, these technology ETFs are highly diversified and usually contain a lot of very niche companies such as microchip companies or robotics companies, and you might not know exactly how they work. So one thing you need to be comfortable with is potentially either doing a lot of research or investing in companies that you might not necessarily know a lot about. Is it too late? This is probably the number one sort of concern when people think about these big technology companies. Have the stock prices already run away too much? When you look at sort of Google and Amazon already in 4 figures for a share, it's always definitely something to consider. Management fees. Because these technology ETFs are quite a bit more niche than, say, a Vanguard Australian Shares Index fund, the management fees are on average quite a bit higher, sort of averaging around 0.5%. When you look at other low-cost index fund ETFs, sort of averaging around sort of 0.1 to 0.2%. It is the cost of trying to invest in a niche area. So let's get started. The first ETF I'd like to show you guys is one called Fang. So according to their website, the Fang Plus ETF aims to provide investors with a return that tracks the performance of the New York Stock Exchange Fang Plus Index by investing in the shares that make up the index in proportion to their index weights. The index focuses on those companies representative of high growth technology or advanced technology-driven sectors such as in the consumer discretionary on the major US stock exchanges. And it includes some of the top innovation leaders across today's technology and tech-enabled companies. And it is equally weighted across all companies and rebalanced quarterly. So what does this actually mean? This ETF is quite unique compared to some of the others I'm going to show you today in the sense that it's quite undiversified. It only has 10 holdings, which I'll show on the screen now. The positive is their fees are quite low relative to some of the other ETFs I'm going to show you at 0.35% per annum. And they pay dividends twice a year, semi-annually, with the last distribution having a 12-month yield of 0.98%. The Fang ETF is actually relatively new, having only been listed on the ASX in February of 2020. From inception to July, the return's actually been really strong at 22.94%, which is quite impressive given the total market crash due to COVID-19 in that period. It's also good to note that whilst the ETF itself is quite new, the index that it's been tracking has obviously been around for quite a time, and the companies in this ETF are staples in any household like Google and Amazon. So my take on the Fang ETF is that it's not really what many would consider a true ETF, in the sense that it only has 10 holdings, which means it's actually not very diversified. But if you're quite bullish on the tech industry specifically, because this contains many of the large cap technology leaders, it's going to be a portfolio pick for you that's going to give good returns, as most of the companies in this ETF are what many would consider too big to fail, with the big risk just being government regulation. So the next ETF I'd like to show you guys is the aptly named Tech ETF. So straight from their website, the Tech ETF aims to provide investors with a return that tracks the performance of the Morningstar Developed Markets Technology Moats Focus Index. Tech uses a full replication strategy to track the index, meaning that it holds all of the shares that make up the index closely in proportion to their index weights. The index comprises of 25 to 50 global technology companies across areas such as software, semiconductors, data processing, computer equipment, and databases. And companies are screened using Morningstar's proprietary moat methodology to include only those companies that are identified as possessing strong competitive advantages relative to their peers. Further, companies are only selected for the index based on how they are attractively priced relative to their fair value. So the Tech ETF currently has 35 holdings, with their top 10 holdings on screen now, and their management fees are sort of in the middle of the ballpark for technology ETFs at 0.5%. One great feature of the Tech ETF are the strong dividend returns. The dividends are paid semi-annually, and the last dividend had a 12-month distribution yield of 9.54%. On top of the great dividends, the Tech ETF has actually had great historical returns as well. It's been around for roughly 3 years, and since inception has returned 25.59% per annum. So my take on the Tech ETF is that it's an extremely solid ETF with great diversification across technology in general, as well as the global exposure it provides as well. The dividends and the historical returns have reflected this. The index that the Tech ETF is tracking actually has quite strict criteria on what it considers companies with a moat. What this means is that these companies in the index will actually have great competitive advantages relative to their peers, and will often have monopolistic tendencies, which will mean that they'll be able to develop long-term growth. And the next ETF I want to share with you guys is an ETF named HACK, and it focuses on a very specific industry within the technology sector in general. So straight from their website again, HACK aims to track the performance of an index that provides exposure to the leading companies in the global cybersecurity sector. HACK currently has 49 holdings, with the top 10 holdings on screen now. As you can see, they have the Aussie dollar as their number one holding. Typically this wouldn't be the case, but I think they've just been rebalancing their portfolio due to the recent dividend distribution, and they typically would not be holding that much in cash. In terms of management fees, the management fees for this HACK ETF are actually quite high at 0.67%. But this is quite typical for a niche ETF. So once you start getting more and more niche, the management fees often will get higher and higher. However, when you try and compare this to the fees of an actively managed fund, they're often at above 1%. The management fees at 0.67% of HACK are not too bad when you get sort of very niche exposure to the cybersecurity sector, if that's something you're looking for as an investor. In terms of dividends for HACK, they're paid out twice a year, with the 12-month distribution yield being 8.2%, which is pretty good, and coupled with its historical returns make this ETF pretty nice. So the HACK ETF is actually relatively old compared to some of the ETFs I'm sharing with you today, being around for almost 4 years. And in that time, it's been able to return 19.97% per annum since inception. which when you think about it is actually quite good given there's been 2 market downturns in that time, both in 2018 and obviously more recently in 2020 due to COVID. So my take on the HAC ETF is that it's another great ETF for those who want exposure to the cybersecurity sector. And when you look at the market in general, it's almost every day now that you sort of hear something about privacy concerns or a company being hacked. And this ETF allows you to get exposure to these companies that are solving these problems every day. So the next ETF I want to share with you guys is one with a demographic focus within technology, and that is the Asia ETF. So again, from their website, the Asia ETF aims to track the performance of an index comprised of the 50 largest technology and online retail stocks in Asia, excluding Japan, including technology giants such as Alibaba, Tencent, Baidu, and JD.com. There are currently 56 holdings in the Asia ETF as of this moment, with the top 10 on your screen now. And again, like HAC, because this ETF is a little bit more niche, focusing on a subsector within tech, the management costs are again a little bit higher at 0.67% per annum. But given that a lot of these companies that it's investing in are located in overseas markets, which are quite costly to invest in as an Australian investor, the management fees aren't too bad. The dividends on the Asia ETF are not that great compared to some of the other ETFs I've been sharing with you at 0.4% per annum, and they're only paid out annually. So the Asia ETF was listed towards the end of 2018, and since inception has returned 17.62% per annum, which isn't as strong as some of the other ETFs I've shared with you today. But what I think is good about it is its past 1-year return, where it's returned over 40% in that time. When you think about COVID happening in that period, the ETF and the companies obviously within the ETF are actually being quite resilient, and it's a good one to have in your portfolio to provide some diversification to Western market technology companies. So the last ETF I want to share with you guys is a brand new ETF right here from Australia, and it's the ATEC ETF. So the ATEC aims to track the performance of the S&P ASX All Technology Index. The index provides exposure to leading ASX listed companies in a range of tech-related market segments such as information technology, consumer electronics, online retail, and medical technology. So ATEC currently has 51 holdings with the top 10 on your screen now, and their management fees are sort of on that average ballpark at 0.48%. But one thing that I would like to share about this is that given that every single one of these companies is just listed on the ASX, it's not too difficult to purchase these companies directly if you wanted to. So it is something to consider if you have the time, or if it makes sense for you to actually just buy these stocks directly on the ASX. So ATEC pays out dividends annually, given that it's filled with mainly growth stocks on the Australian stock market. And whilst the ETF is relatively new, so they don't have a 12-month distribution yield on their website, they did just pay out a dividend very recently, and it was at 27 cents a share, which worked out to be around 1.5% in terms of a 12-month yield. Because the ATech ETF is so new, it's tough to talk much about the historical returns. But since March, it has returned 13.29% per annum. And when you compare that to the ASX 200 or just the Australian stock market in general, that's been significantly better. So I think ATech is a nice one to have in your portfolio if you want a really easy way to include a lot of Australian technology companies in your portfolio. And it's a great one just to have available for investors. My one sort of concern with this ETF is that I wouldn't consider a lot of the companies in the ETF sort of true technology companies. When you look at companies like car sales or real estate group or even Afterpay, they aren't what you would consider pure technology companies. I would say they're probably more companies that are using technology to give them a competitive advantage in a specific industry or sector. But it does mean they're typically able to outperform their peers. And the ETF does include technology companies such as Xero, which have performed extremely well over the last few years. So I just wanted to do a final note on a ETF that I know is very popular on the ASX for people who want to gain exposure to technology, and why I didn't include it in this video, and that's the NASDAQ 100 ETF, or just NDQ. And the main reason is that it's actually just not a pure technology focused ETF. It's just an ETF that focuses on the top 100 companies that are non-financial on the NASDAQ. And it just happens that these mainly are technology companies, which is, probably a good sign that technology is actually a good industry or sector to be investing in general. So those are the 5 ETFs on the ASX that I would consider to be the best sort of pure technology ETFs. As always, do your own research before investing, and let me know in the comments if you think there's an ETF I missed, or if there's an ETF that you'd like me to cover later on. If this video helped you out at all, please give the video a like and subscribe, and I'll see you guys in the next one. Peace.